Are you about to retire but unsure when is the best time because of tax implications? Do you have unused long service leave, holiday pay, or sick leave accrued and wondering how this will impact your final pay? In this video, we will go through all the reasons why you need to take all this into consideration when thinking about retirement and the steps you should consider before retiring. Hi, and welcome to the Retire Well project. My name is Bourne, and I am a retired financial advisor with over 40 years' experience in taxation, superannuation, and retirement planning. My focus is now on helping people to understand the complexities around our superannuation and tax rules so they can maximize their benefits for retirement. In this video, we will look at the tax implications of retirement and how it can impact your superannuation so you can plan around the best time of the year that you should retire. The simplest way to explain this is to go through a worked example of the best and worst times of the year to retire, and the impact of taking lump sums at retirement for unused leave, or taking them before retirement. Before we look at our worked example, let's look at the typical termination payments you may receive on retirement. Unused annual leave. If you are owed anything for accrued annual leave on retirement, this will be paid as a lump sum. Annual leave accrues at the rate of 4 weeks for every year of service, and there is normally an annual leave loading of 17.5% added to this. Where the termination is due to normal retirement, this lump sum will be added to your normal income and taxed at your marginal rate of tax. If the termination is due to redundancy, early retirement scheme, or part of the benefits accrued prior to 17th August 1993, then different tax rates apply. Our video today will only look at normal or voluntary retirement with any benefits accruing after August 1993. I will have another video on how termination payments are calculated due to redundancy or early retirement schemes. If you take annual leave during your normal employment, then your employer is obligated to pay superannuation on that amount. If your annual leave is paid out as a lump sum on termination, then there is no obligation for your employer to pay super. Long service leave is also included as a termination payment if you have qualified for the minimum period of service. Typically, long service leave accrues at the rate of 0.866 weeks for every year of service after you have served a minimum number of years with the same employer. This could be 10 or 15 years, but will be determined by the specific workplace agreement that is in place. In some cases, it could be less than 10 years, so you should check your entitlements before you actually retire. As with annual leave, no super is payable on long service leave when taken as a lump sum on termination. If it is taken during normal employment, then super is paid on long service leave. Termination payments could also include redundancy payments, but we will address these in another video as we are only looking at normal retirement today. Sick leave normally accrues at the rate of 10 days per year, but this could vary depending on any workplace agreement. Unused sick leave is never paid out on retirement unless it is allowed for in any workplace agreement. In most cases, any unused sick leave is forfeited on retirement. Let's look at Joe, who has just turned 67 and is now eligible for the age pension. He has been working with the same company for the last 20 years and is on an annual income of $85,000 per year. He has 5 weeks accrued annual leave and 120 days of unused sick leave, plus 17 weeks of accrued long service leave. He has $400,000 in superannuation. Let's look at the worst-case scenario first. If Joe decides to retire on the 30th of June 2025, he will have a full year's income. His weekly pay before tax is $1,635 in round figures. His termination pay will also include a lump sum for accrued annual leave of 5 weeks equating to $8,175 plus 17.5% annual leave loading equaling $1,431. Joe will also receive a lump sum payment for his unused long service leave of 17 weeks, which equates to another $27,795. The unused sick leave is forfeited on termination. The company is not obligated to pay superannuation on lump sum termination payments for annual leave or long service leave, so Joe ends up with a total of $9,775 of employer super contributions for the year, based on the minimum guarantee rate of 11.5% of $85,000. The lump sum payments for unused long service leave and annual leave are treated by the tax office as normal income and taxed at marginal rates. To summarize Joe's situation, he has a taxable income of $122,401. His tax payable would be $27,508 before Medicare levy based on 2024-25 tax rates. Apart from his normal weekly or monthly wage, Joe would also be leaving with a lump sum of around $26,000 after tax, which could mean delaying any withdrawals from superannuation or starting an income stream from his super until he has used these funds. The lump sums received on retiring will not be counted by Centrelink as income, as they are not considered employment income. If Joe places these funds in the bank, they will be assessed under the assets test, and the deemed income on his bank account will be assessed under the income test. Let's now look at the scenario of Joe retiring on July 1st. While the annual leave and long service leave entitlements would be adjusted for one extra day, we will assume the same amounts for this example. Joe's final pay would be for 1 day plus the lump sum of $37,401 for annual leave, long service leave, and leave loading. This gives him a total income of $37,728. If Joe had no other income for the year, then his tax would be $2,929, taking into account the tax cut from 16% to 15% on the income below $45,000. The tax on his income of $85,000 would be $16,288. If this was the only income he received in the 24-25 tax year, by delaying his retirement until the new financial year. Again, this is before any Medicare levy and also does not take into account any tax offsets for low income or the Seniors and Pensioners tax offset known as SAPTO. So, if Joe retires on June 30th in 2025, he would pay $27,508 in tax, but by delaying his retirement for 1 day, his tax reduces to $19,217 over 2 financial years. This is a tax saving of $8,291. Again, I stress this does not take into account any other income or Medicare levy. If Joe was eligible for the age pension, this would be counted as a taxable payment and would be included in his taxable income for the 2026 year, which could push him into a higher tax bracket. Let's now look at a third option, and that is using up all of the accrued leave benefits before retiring. Joe has 17 weeks of long service leave and 5 weeks of annual leave. Subject to his employer's acceptance, Joe could take this leave prior to retiring. Joe also has 120 days of sick leave available. I have known clients to utilize this by getting important medical procedures done while still employed. It may be that degenerative hip that needs replacing, which prevents you from working, or the sudden onset of tooth pain leading to full dental implant surgery. Whatever the situation is, consider this before retiring, as any sick leave you have accrued will be forfeited on retirement. For the purposes of this exercise, we will only look at Joe's unused annual leave and long service leave. With a total of 22 weeks, it means Joe could actually stop working on July 1 and continue to be paid for 22 weeks with the added benefit of receiving superannuation contributions for that period of time. He would then come back to work for 1 day and retire, but any such arrangement is best discussed with your employer. 22 weeks pay plus the annual leave loading means Joe would earn $37,728 in the 2026 year. The superannuation contribution by his employer is now 12%, which is the rate from the 1st of July 2025. This amounts to $4,488, which Joe would not have received if he elected to be paid a lump sum. Joe still gets to stop working on 1st July subject to his employer wanting him to return to formalise his retirement for one day, and his tax situation remains the same as compared to taking the lump sum option on the 1st of July. The income Joe receives while serving out his time for long service leave and annual leave is counted as income by Centrelink under the incomes test for the age pension, so this must be taken into consideration. So, the conclusion to be drawn from this example is that it is more beneficial to utilise any accrued benefits while still working, rather than taking them as a lump sum due to the fact super is paid if you take them while still working, but not if you take them as a lump sum. The other conclusion we can draw from this example is to retire early in the new financial year to avoid the impact of having lump sums added to a full year's income if you retired late in a financial year. Everyone's situation is different, which can impact your tax situation, superannuation situation, and age pension eligibility. So make sure you get advice if you are uncertain about the best time to retire. I hope you found this video helpful. If you have any comments, please leave them in the description below and subscribe to the channel if you would like to access our other videos or be notified when we release new ones. Thanks for watching.